Good day, fellow investors. Volkswagen stock has crashed to something that looks like the world is ending. And I read this comment on a previous video that I made on the risk of owning automotive stocks. The stocks are all severely down, and the comment shows capitulation as the person is selling out. And that's also reflected in the stock prices. We are down 44% over the last 6 months. From the 2021 peak, the stock is down an amazing 66% for Volkswagen. That's insane. But if I look at the market capitalization, 45 billion, again, something insane. If you look at the production units for Volkswagen, 9 million, which means if I divide the 9 million by the 45 billion, you are buying Volkswagen at 5,000 euros per produced car. 5,000 euros per produced car. If they make in a good year 2,000 on profit on a car, that's a P ratio of 2.5. And on the latest earnings, we are not far from that P ratio of 3.36. But what's going on now? Well, there are some issues in Germany. The new CEO says cost cutting needed fix decades of structural problems. Labor officials say company to close at least 3 German plants, preparing cost-saving plan. And the news there is about the CEO. Costs in Germany must go massively down, and the workers in Germany would see him torched about that. But the problem, yes, is there. Weak demand in Europe, significantly reduced revenues from China, expose decades of structural problems at Volkswagen, as the CEO is saying. But Volkswagen managed to raise 2.75 billion on the bond market at good terms, and they need to raise much more, as you will see later in the terms. They have a 30 billion debt issuance program. But if I look at the interest rates, Europe is lowering rates because these companies cannot survive with higher rates. If you look at how much Volkswagen borrowed in the past, you can see here 0.85. That is free money. Free money 2017, 2020. Okay, more recently 4.2, which is a little bit more expensive. But if this goes to 7, 8%, then Volkswagen is gone, and rates have been going up, thus the price of the bond is going higher. Because if you look at the inclusion here in cost of goods sold for the first 9 months of this year, 7.75 million is just interest expenses, which is a lot, and we'll discuss the debt later. But let's discuss now about the company, and they are innovating a lot of investments, new vehicles, new makes, new this, new that. They are going into Rivian, they are doing the Scout motors. So a lot of things going on, but what happened is that sales are a little bit less than compared to previous year. And then you say, Sven, sales are just a little bit less. Why is the stock tanking? Because just a small change in sales, just a small change in operating margins leads to a big change in profitability down the road. Earnings per share are still there for the year, but on a quarterly basis much lower, and cash flows also much lower. And you can see here just 3 billion now, and they still paid the dividend, but their liquidity is really contracting. However, they need to invest a lot, 13% of revenue, into capex, research and development, just to keep up high investments. But China is down significantly, 37%. Guess what? The Chinese can produce their own cars. Booyah! And those are the structural problems. Operating margin is down just a little bit, and the expectations are still for a solid quarter. But let's talk about the debt. There is financial liabilities 121 billion, long-term liabilities 133, and there are also pension provisions, other liabilities, and other liabilities short-term So when you stack things up, I quickly get to 300 billion euros of liabilities. And 300 billion euros are a lot. Not a lot if interest rates are 0, 1, 2%. If interest rates go up, if people are afraid of lending money to Volkswagen, then the whole financial house of cards collapses. And this is something that I've been discussing over the last years as a huge risk for car companies, especially when the stock price went to the moon, but there was this financing risk there. The next risk is a slowdown. We are still far from a recession, but things are already slowing down. The economy is good. European economy, global economy, China economy, stimulus, American economy, lowering rates, everything. The economy is still good. If that reflects into Volkswagen's car sales in the next 4 months, this is an easy 2x. However, if interest rates change for the borrowing costs, if the EU cannot give free money anymore, that's a huge risk for the company, for its competitiveness, investments, whatever. And that also trickles down into the competitive advantage that these companies had for the last 10-15 years that will unlikely be there in the future. It is always about weighing that risk and reward. As I said, if there is a recession, the crash will continue and Volkswagen will be even cheaper. There will be debt issues, covenants, higher interest rates, saving by the government. If there is a big recession, Volkswagen will have the need to be saved by the German government alongside with Daimler and all the other car companies in Europe because of the extreme financial structures that they have built their sales on. But if there is no recession, if things improve, that's a 2x and then the company can go bankrupt. That's a bet as a value investor I don't want to take because there is the permanent capital loss potential. However, some of you asked, what about Porsche? Well, market cap 28 billion, P ratio 14, dividend yield okay. From the IPO, it's a little bit down. It's still a little bit expensive for being a bargain, but it's owned 75% by Volkswagen, 75% of 28, where am I? 20 billion, so half of the market cap almost of Volkswagen is just Porsche. I don't know whether they could sell this or implement it into the company. There is also the holding that represents Volkswagen, again, more at a discount, plus a dividend that they are paying out, plus the other investments. I didn't look, but there will always be a holding discount there. However, back to Porsche as the company, yes, they are doing their thing, investing, selling a little bit down, profits already a little bit down. If there is a recession, it will go lower. If not, profits will be strong there. And there is a robust order book, so things look well, new models, and there will be an improvement for the end of the year. They say electric cars are selling a little bit lower. That's also reflected in lithium prices, which is always important to watch. But the profits are there, they are down, the stock is cheap, and this is another way to play things. Porsche will need to be sold if Volkswagen gets into trouble. So this is then again priced completely different, not a P ratio of 3, a P ratio of 10, 12. Can it go to 20? Yes, but there is always the cyclical bet. At this moment in time, I cannot give you a call. Maybe for 6 months, 12 months, as rates are going lower, these companies can pick up a little bit, and because of the capitulation in the stock price, you can make some money. But there is the risk of Volkswagen going bankrupt, Porsche unlikely because some company will pay 20 billion just for the brand, and in 5 years you'll have half of China driving Porsches. But that's a different story. The risks are there, and therefore I would not go into that myself. Even if it looks cheap, there is the potential, but the risk and reward is fair. And you have to see how this fits your portfolio.